So we are going to be talking about the tax proposals from both the Harris and the Trump candidacies, just to give us a comparison. And then we will also look at the Tax Cuts and Jobs Act, which basically is the tax code that we have now. That is going to sunset, so that is a provision that we need to be prepared for. But like I said, we'll talk about the candidates, we'll talk about the Tax Cuts and Job Act, and then we'll get into the investment implications and opportunities that come up. So I think it's really important to understand where the information that I'm going to present today is coming from. So all of these sources you can see are the budget of the United States government, the Congressional Budget Office, the general explanation of the administration's fiscal 2025 revenue proposal, and that was released in March of this year, the Tax Foundation, Cato Institute, the IRS, and then the Tax Cuts and Jobs Act. One thing that you'll note is you don't see social or corporate media sources. We felt like we wanted to get as accurate a picture as possible without any partisanship. So these are the sources, and every slide is sourced. Well, let's talk about our budget deficits before we jump into taxes, because taxes are used to pay for all of the great things that this country provides for us. But you can see that we've been running a deficit, and it continues to grow. So in 2020, we had a record $3.13 trillion deficit. Now, that was much attributed to the COVID situation, but we've continued to stay in a deficit situation. In 2021, it was 2.8 trillion. In 22, 1.4 trillion, and in 23, 1.7 trillion. Currently, we are at 1.5 trillion for 2024. Of course, the year isn't over. So we can see that this is not a way that we will be sustainable. And so taxes will come into play. Unfortunately, legislation has not been sufficient to reduce our national debt. And you can see by the dark line is our gross debt in millions that has grown year over year and significantly in the last 2 decades. The gross debt to GDP percentage, which you can see ballooned back here. Let me put my little highlighter here. You can see it ballooned back here, and that was during World War II. And then we were slowly able to get that reduced, but we've seen an escalation in the past couple of years, and we estimate that that will continue, right? So legislation has not been sufficient enough to reduce the debt. So normally taxes are the next step that we go to. I think another really important view is the percent of all federal spending. Right now, 73.5% of all of our federal spending is on mandatory items, such as Social Security, Medicare, Medicaid, health programs, welfare, and then 13.3% is spent on the interest alone. So that only leaves 26.5% for defense and everything else. And that number continues to grow. And our estimates are that by 2043, that we will have no additional funds for defense or any other spending, because all of these other areas, these mandatory spending, will take up all the money that is being brought in. And so that is very critical, and it needs to be addressed. And it's something that our politicians on both sides of the aisle really are not enthusiastic about confronting. And we as Americans need to step up and tell them that's not acceptable, because this is really putting us at risk. Can you imagine not having any defense budget at all? I cannot. So I thought Ronald Reagan had a very good words of wisdom here. He said, we don't have $1 trillion debt because we haven't taxed enough. We have $1 trillion debt because we spend too much, right? And so true. So taxation alone won't get us to where we need to be. We need to do a combination of both in order to get us to a healthy GDP to debt ratio. So that kind of sets the stage for why is it important to talk about taxes and why it is so much in the forefront. So our comparison now will be based on information that I've researched from the Tax Foundation. This is a great website. I recommend that you note it down because the Tax Foundation takes the information from each one of the candidates and gives us a side-by-side comparison of what they are proposing. Then they also do analysis of what would that result be? What is the impact to gross domestic product or GDP? What kind of deficit will that continue to create? And so it's a really great place without any partisanship to take a look at where that information is put all together at one place. And that's what I used for the information that you're going to see today. So let's take a look at a side-by-side comparison, and we'll look at several different aspects of the tax code. Now, I'm not going to go over every bit because it is lengthy, but I will go over those that do affect your investments. So on the left side, we have the Harris proposal, and on the right, the Trump proposal. And again, we're focusing right now on this slide for the income tax proposal, right? So let's take a look there at what we see as far as the top tax rate. So Harris is proposing that we raise the top tax rate to 39.6%, and that we also lower that top tax bracket. So it'll go to 400,000 for single and 450 for joint. Just to give you a sense of where we are now, the top tax bracket of 37% doesn't hit a single taxpayer until they're at 609,000 or joint at 731,000. So you can see that's a big gap. If you are in between that amount, you're going to see a significant raise, right? Trump says, no, we're not going to make any changes to the current program. Then both of the candidates like the no tax on tips. The Harris camp has said there's certain professions, so it's not open to all. There's been no exclusions on the Trump side. And Trump also was looking at overtime pay not being taxed. Both the candidates like raising the tax credits for the child care credit. Right now it's at $2,000. Harris is talking about a sort of a tiered, starting out at $6,000 for newborns, and then 3.5 for toddlers, and then 3,000 for children. Whereas there's just a flat 5,000 on the Trump side. Really, the Harris proposal is looking at earned income, premium, and housing and tax credits, right? So they're really trying to position people in certain areas and giving them additional benefits. And then they also are increasing the startup deduction to 50,000. So startup businesses. So right now it's at 5. So that would be the raise there. So on the Trump side, he wants to reinstate the unlimited itemized deduction for SALT. And for those of us on the call who live in state tax states, that's a big hurrah, and that the current program does not allow that. There's a cap at 10,000. This would have it unlimited, right? So that would be a change there. And then, of course, all of the proposals that we have right now, they would like to make those permanent. So the Tax Cuts and Jobs Act, making that a permanent part of our tax code. All right. Next, we've heard a lot, seen and heard a lot about this capital gains and some changes there. So on the Harris side, she wants to raise the capital gains rate to 28%. So currently for the highest income earners, it's at 20%. So that would be a change, a significant change there. And then I think you've probably heard about the billionaire tax. And this is where unrealized gains would be taxed, not only on your investments, your stocks and your bonds, but also on real property as well. Of course, that's not going to hit until your income is at 100 million. So it won't hit a lot of people, but that's really a departure for unrealized gains being taxed. That has never been accomplished here in the United States or even attempted. On the Trump side, no changes to either capital gains or any minimum tax on the most wealthy. So next, we go here on the Medicare surtax. Again, a comparison. So right now, Harris is proposing that those who make over 400,000 will pay 5%. So right now it's at 3.8% for anyone making over 200,000. So that would be an additional tax on top of the regular income tax that they're paying. And then here on this section 1031 exchanges. So that's when you buy a property and its value expands and you decide to sell that property and immediately put those funds towards a new property, a bigger property. Well, you're able to take the gains that you have put from the original property, you're able to exclude them. So right now there's no limit on the exclusion. If you made $1 million on one house and you sold another and bought another, then there would be no capital gains. Harris is proposing that there be a cap of 500,000 on that. So that is a difference. Trump says continue with the no limit on that and no increase on this Medicare surtax. All right. So here on retirement plans, this is really where I pull up my chair and I look because there's some significant changes here. Now, there's some changes for those with very large 401ks. If it's over 10 million, they're going to have to take 50% out, which will be taxed immediately, as opposed to keeping it in the investment and taking it out as needed or with required minimum distribution. That's a big change. But here's really where things make a big departure to what we have right now. And that's with our Roth IRAs. So currently, I have a lot of clients who are using the backdoor Roth IRA. And for those who aren't familiar, that's for folks who make a certain amount of money that aren't able to invest directly into a Roth. They put money into a traditional IRA and do an immediate conversion before it's been invested, so there's no capital gains. And that's been a great way for high income earners to utilize the Roth IRA. Remember, the Roth IRA is after-tax money that is never taxed on withdrawals. Even the profits or the gains are never taxed. So that would be an elimination, and that would affect a lot of people in their financial plans. Then there's also the mega backdoor conversion. A mega backdoor is when you've fully funded your 401k, but you'd like to add additional monies, and your employer allows that by putting in after-tax funds into the 401k. And for high income earners, this is another way for them to save in a tax-deferred investment, which would be actually tax exempt because it's Roth. Well, that would be excluded, so that would no longer be available. And then here, no Roth conversions for high income tax payers. And again, that's anyone over 400,000 single or 450,000. Again, Roth conversions are a great way of taking taxable retirement income and paying the tax now and then having tax-free income in retirement. So those are significant changes. And then also limiting the retirement contributions for high earners. So there are limits every year about how much you can put into your 401k, but if you made a certain amount, and that hasn't been disclosed, the amount, then you would not be able to fully maximize that, okay? On the Trump side, everything remains as is, no changes there, continuing to have the backdoor, continuing to have the mega Roth conversion, and of course, no caps on Roth conversions as well. So when I'm doing planning for clients, it's really important that we bring those into consideration. And again, they've been a tool that we've used for many years now. So on estate gets complicated, and once we know where the direction of our tax code is going on estate, I'd like to actually bring an estate planning attorney on, and we'll do a webinar on that. But there are a few that do have implications from an investment standpoint that I wanted to note for everyone on the call. One here is the gift exclusion. So a lot of folks trying to get their taxable estate down will gift money to their children, their grandchildren, to someone that they care about to reduce their estate. And it's also a nice way to pass along your assets to your heir. Well, at this point, you can give 18,000 to anyone for an unlimited amount of time for the rest of your life. So the Harris proposal is that it will be limited to a total of 50,000 in your lifetime. So about 2.5 years, and that's all that you would be able to give to an individual, whereas now it's unlimited. Then here is a really big one we're looking at is the transfer of appreciated property. So we call this the step up in death. So if you've ever inherited any stock, ever inherited any property from a family member, or even a friend, you get a step up in death and to the cost that it is today. So if your grandmother bought the stock at $1 a share and it's now $100 and she passes away and gives it to you, then the cost basis or the area that they look at for capital appreciation would go to $100. Well, that would be eliminated. And then also the estate tax right now is at 13.61 million per person. So if you have that, if your estate is that or lower, you don't have to pay estate tax. Well, they would reduce that down to 5 million. So many people who were not being affected by estate tax would receive an estate tax bill. So there's going to be a lot for estate planning attorneys to do if these go into place, right? No changes on the Trump side. All of the current legislation and regulations would remain in place. If I don't erase these, they show up on the next slide, I've noticed. So that's why I'm erasing each time. Thanks for your patience. Okay. Here, again, more changes on the estate tax. I'm not going to spend a whole lot of time, but the generation skipping, trying to pass on assets to your heirs, there would be limitations and either eliminations or limits on those as well. So here's the business and the excise tax. So you can see on the Harris proposal a lot about raising taxes and kind of limiting the amount of tax cuts. So this is where you see the Trump folks step in and they're looking at tariffs. And so we'll spend a little bit more time on this one because I know that there's been a lot of that in the news. So on the Harris side, she wants to increase the corporate tax rate to 28%. So currently it is at 21%, and she wants to raise it up to 28%. So you say, well, who cares? It's the corporations, they need to pay. But what happens here, though, is it does affect the stock market. So for every 1% that the corporate taxes go up, the earnings of the stocks, which is based on which gives you the value of the stock, goes down by 1%. So if you're a stockholder, you're invested in the markets, this will impact you. So that's one thing that I think is not known widely by the general public. So that does have an impact to you. So Trump's proposal is to actually reduce the corporate tax rate by another 1% to make us globally competitive to 20%. And then on companies that build their products exclusively here in the United States, the rate would actually go down to 15%. Again, trying to raise the amount of companies, lowering their tax burden so that they grow and expand, hire more people. That's the philosophy under those rules. Heard a lot about the baseline tariffs. So just an aside, we've had tariffs for a long time. We had tariffs through the Obama administration, all through the Biden administration, kept all of the tariffs from the Trump administration prior. So those would be continued, and those are really, that's where the funding is coming from. What's really throwing a lot of people off is the 60% for China. There's no details on this, and I have no idea what people are thinking in their head. Maybe this is a manipulation tool, a negotiation tool. It would cause prices to rise for the goods that we import from China and could cause strife and a trade war. So that is a big part of the big component of the Trump proposal. There's not a whole lot of details on that, but that's really where, instead of raising taxes on the individual, that's really where they're looking for raising the money in order to continue to keep our taxes low. Right. And then the last thing here is the stock buyback. So a lot of companies will buy back their stock, and that eliminates the amount of stock that's available out there to the public. And right now there's a 1% excise tax on that. So you would be telling corporations, if you're going to buy back your stock, we're going to tax you at 4%. So that would mean companies would be less encouraged to buy back their stock, which would have an impact to the share price of the stock. One thing that I thought was interesting here is under the Trump proposal is that to start taxing the large private university endowments. And we've all heard about Harvard. Harvard is about $50 billion endowment, and they don't have to pay taxes on it. So that might be a good area for us to tap in order to hopefully reduce that deficit or allow us to have the revenue that we need to run the country. So you can see between the two, very different. So the Harris proposal is based on the supply side. So if you remember back in your econ classes, the Keynesian method, that's really where they're focused on. Raising the taxes, redistributing the wealth through the credits that they provide, bigger government. So those are sort of the three hallmarks on the Harris side. On the Trump side, it's the demand economic theory. And so that is reduce taxes so that the businesses will grow, so your base will grow. So in the end, you actually will keep taxes flowing in because there's more people paying taxes because there's more people working, and smaller government. So very, very, very different philosophies between the two camps. The one thing to know is these are Christmas wish lists from our candidates, because the only way that we can get tax changes is not through an executive order. It has to start in the House. The Ways and Means Committee has to put forth a bill with these provisions. Then it has to go through the House and be approved. Then it has to go to the Senate, and then the president signs. So not all of this is going to happen, but I wanted you to get a sense of where each side is really focusing on where they're raising the funds to run the country. It's very likely that whoever gets into power, you'll see a little bit of this and a little bit of that, right? And that's the a bipartisan bill is more likely. If we get a divided government, meaning a Republican or a Democrat president, and then the House and the Senate are split, then you're likely to see more compromise and maybe a little smattering of this and that. So I know there's a lot to go over here, but I think it's a really good way of kind of understanding where each one of the candidates are coming from. So now, what happens if the current tax rates expire, right? Well, the one thing about the Tax Cuts and Jobs Act, that's the TCJA, is that politicians don't have to do anything in order for it to go away. And politicians are really good about doing nothing. I think we'd all agree. So here we have a situation where we've got the current, this is the current tax laws that we're living in right now. And if nothing happens, then they will sunset. That's what they call it, sunsetting. That means they go away. And the tax code that we had before would come back into play. So let's see what happens if that comes to fruition, because it's pretty impactful. What will happen is the tax rates will increase for most taxpayers. 62% of taxpayers will see an increase in their taxes. So that's more than half of the nation, and it's a lot of people will be impacted. Deductions, those standard deductions, the high standard deductions that we have now, will drop to nearly half for many taxpayers. And if you're wondering, well, how many people use the standard deduction? 95% of Americans use the standard deduction as opposed to the itemization. So that is a huge amount of change for most Americans. The limit on the state and local taxes, that will be removed, which was one of the areas there's a lot of pushback. We did note that Trump is saying he would repeal that anyway if he's able to make some changes. But that would come back for those taxes, those states that have high state taxes. That would be positive for them. Now this one is a real killer, and I'll show you a chart on it. It's pretty crazy. The alternative minimum tax, it will make a comeback. The AMT is another way of looking at your tax base, and I'll go into detail on that in just a moment. And then limitations on itemized deductions that will end. So many deductions that we were able to take prior to the Tax Cuts and Jobs Act, prior to 2017, they will come back, right? The Tax Foundation really thinks that's a negative because it makes the tax code more cumbersome, right? Now it's easy. You just do your standard deduction. Remember those days when you had shoeboxes full of receipts that you had to keep track of and itemize? Well, that would come back. The personal exemptions will make a comeback, but the phase outs will also make a comeback as well, right? Then the elimination of the 20% qualified business income deduction. This is for small businesses. This is for your partnerships, your LLCs. And this 20% qualified business income is a huge bonus for them. That would go away. So their revenue, their taxable revenue would go up substantially. And then the unified gifts and estate tax, we talked about that before, that would drop in half. So the estate tax number would go way up. So those who are likely to be hit with an estate tax or their heirs, folks who are not impacted at all will see a huge increase. So there's a few of these I wanted to spend a moment with. So here's our income rates. This is if it sunsets. Let's not think the tax rates that I talked about between the two candidates, that's not involved here. This is just going back to the rates prior to 2017. So you'll see even a single earner who makes $11,000, $11,601 is going to be impacted. They're going to go from 12% to 15%, right? So that's why I said 62% of Americans are going to be impacted by the change, just letting this sunset. And we'll also see that the top tax rate will go from 37% to 39.6%. So that's a big change. That's a big step. So good to note that if we do nothing, almost all of us are going to be impacted. And we'll take a look at the standard deduction that we all like so well, since 95% of us are using it. So today, a person can take 14.6, and married filing jointly 29.2, right off of their income and reducing their tax. We estimate that will go to $8,300 for single and $16,500 for married filing jointly. So that's a big drop. So let's take a look at what that would look like for a couple that's making, we'll say, the $250,000. So we've got the couple and they're making $250,000 prior to the sunsetting. Then they would be in the 24% tax bracket, and their effective rate would be 15.63%. After, if it sunsets, they're going to see a huge amount of tax increase, almost $10,000, $9,682. They're going to jump up to the 28% tax bracket, and their effective rate will be 19.5%. So by doing absolutely nothing, it's going to cost many, many Americans a whole lot more. So we have to be talking to our elected officials and making sure that they take care of us and that they understand the impact of letting this provision sunset. Now let's take a look at the old AMT, right? So AMT has a very high phase out right now, meaning you're not eligible for it until you're at 1.2 million for a couple. And I think the impact is really significant if you look at this from a chart, and I'll show you that in a moment. So again, AMT is another way of looking at your taxable income. You can look at the adjusted gross income amount that we use on our tax forms, but then you also have to calculate the AMT. Well, that removes deductions such as your state and local taxes, your real estate taxes, your personal property taxes, and personal exemptions. So when you take all of that, so many more people will be affected. And let's take a look at how many. So this is where we are right now, right? So that nice little low bar right here, this is where we've been sitting since the Tax Cuts and Jobs Act came into being. If we go back, just revert back, it's going to go up here. So between, what is that, about 7 million individuals will be affected by this AMT comeback. I don't want that to come back, and I don't think anyone on this call would like that either. So very important that, like I said, that we're talking to our elected officials. So when we look at our portfolios, if we have these items in mind, let me get rid of this. I don't know why these are following me from side to side. What we're looking for here is, based on what happens from a tax perspective, what are we looking at in the portfolios to make sure that we're being as efficient as possible? So we're looking at the turnover ratio. How often are shares bought and sold, giving us maybe capital gains? So that's important that's reviewed. The average after-tax return. So if I'm looking at an investment for a client, I want to make sure that the after-tax return makes sense for the risk that they're taking in the environment of a new tax environment. We're looking at pass-through gains. Some pass-through gains may be eliminated if there's changes in the tax code. Pass-through gains means that you don't have to pay taxes on the way an investment passes through income, dividends, and interest to you. How long do I need to hold my investment to get to long-term capital gains? That will be a great way of trying to reduce that. But again, if the capital gains rates go up, you got to make some changes. What's the cost of rebalancing a portfolio, right? I don't want to rebalance if it's going to cause me a huge tax bill. Kind of takes away all of the gains or many of the gains that I've provided. So looking at that. And also looking at the tax drag. So the drag on the portfolio that taxes are causing, and how to eliminate or reduce those so that at the end, the performance and the amount of gain is the highest that each portfolio can provide. But most people, again, they really don't think about how taxes affect their portfolio, but they are significant. So here we look at a lot of different types of strategies for clients, right? Because there's different sort of, we call these buckets of money, right? There's tax-free accounts, right? But we can utilize municipal bonds which allows us to reduce our tax burdens there. We, in taxable accounts, what kind of investments are we looking at? The most tax efficient, and then the utilization of tax deferred and tax exempt accounts that allow our monies to grow without being taxed on an annual basis. And then we also look at other insurance type areas like annuities, and then helping clients support their employer plans like 401ks and 403bs. So there's no one strategy that fits each person. Really depends on the state that they live in, where they are in their process, their investment process. Are they adding to their portfolios, or are they in retirement, right? How much income is needed, etc. One of the areas on the gift tax exemption is for the amount that will, if there's sunsetting, the amount that is exempt will go from 13.6 million, and we estimate it to be about 7 million. That is an estimate number that comes from the Cato Institute. And basically that is an inflated number from where it was last in 2017 to now. But for many people who thought, oh, I don't have to worry about estate tax, it's all going to pass along to my children, without any taxation, that's a big burden. And the tax rate for estate tax is much higher than the individual tax rate. It can be 40%. So that top tax rate right now is at 40%. So that is a huge loss. So we will be looking at estate issues and insurance and ways to cover that tax burden so that you can pass along as much as possible to your family. So in summary, it's really important that we consider different financial strategies as the tax environment changes. Hard to believe that just a few little tax code changes can have a ripple effect within your portfolio. And we want to make sure that our decisions are based on the current tax rate and not things that have been in the past, and that we make those adjustments. And then I believe overall this whole presentation is about how these changes can affect your family and that we can be proactive. The Tax Cut and Job Act will sunset at the end of next year, at the end of 2025. So once we have an idea of what's happening from a legislative standpoint, where the White House, the House and the Senate stand, and how aggressive they're going to be on tax code, we can make better preparation for what's to come. Yeah. So now I'd just like to open it up for any questions that you may have. I know that Christy has been monitoring some of our questions. Yes, okay. All right. And so I see, let me see here. Okay. Right. So one of the questions, I think this question came in before, it asked about can the president just do an executive order and make that change? No, the good thing is that the legislators have to be part of that. So the Ways and Means Committee in the House will start that process, goes to the Senate, and then the president will have to approve it or veto it, right? Okay. So next question is, what do we think will be the outcome? Well, I can't make that prediction as far as where I think we will be from a Republican-Democrat split. I do find, and we have found from research, that a split Congress is most advantageous to the markets, and you will find that there's more partisanship. If it's all, certainly if it's a straight ticket on either side. So this way you would be able to have some compromise, which we could use. I would love to see the politicians talk about reducing our debt and not just continuing to spend. I think that has to be part of this total package. And if we can do it by growing the economy and being fair and with the taxes, then that's the best of both worlds for everyone. Yeah. Okay. We have a question about volatility in the markets because of the presidential situation. Yes, there's a lot of volatility in the markets right now because markets don't like the unknown. We've also got conflicts in the Middle East. We've got I think it has happened. We've got the dock workers are on strike, so that means the supply chain will be impacted. So yes, there's a lot of volatility in the markets right now. You're going to see a lot of spikes and ups and downs. So our recommendation here is just to stay the course, follow the goals that you have set in place. The portfolios that we create for clients will weather through the short-term ups and downs. The market, there's always something that makes the markets go up and down. And what we want to do is stay the course, making sure the investments that we have are sound, making sure that they are leading to the goals that we have set in place. So no panicking. Markets will go up and down. They'll do that for the rest of our lives. And we just need to make sure that we don't panic, jump out when we're feeling uncomfortable with the markets. That has proven always to be a very bad strategy moving forward. Any other questions? Great questions. Thank you for those who asked. Any questions about the tax codes? Anything that I was unclear about? I didn't mention that one of the provisions on the Trump side was to reduce taxes or eliminate taxes on Social Security. So for anybody that's retired, that is significant. How that's going to be done, again, we don't know about that. Again, that's on his wish list, but I do know that that would be very welcome to many, many retirees across the country. Well, thank you very much. I really appreciate you joining us today. Again, I think this will be the first of several webinars that we will hold on the tax code. And as more information unfolds, we will pass that along to you. Thank you very much. Have a wonderful day.